Alright, so let's talk about something incredibly important that almost nobody really explains properly: your credit score. It's a simple 3-digit number, usually between 300 and 850, that tells lenders how responsible you are with borrowed money. It's not just some random number, it's a detailed summary of your history with debt. Have you paid your bills on time? How much money do you owe? How long have you been using credit? All of these things get crunched by fancy algorithms to spit out a single powerful number. This number can open doors or slam them shut. You might be thinking, I pay with debit, I get it, but you'll likely need credit someday. This score is what banks look at, this score is what landlords look at, this score is what some employers look at. A high score says dependable, a low score says risk. It's generated by 3 main companies: Experian, Equifax, TransUnion. They collect data from creditors like credit card companies, auto loan providers, mortgage lenders. That gets compiled into a credit report, and then a model like FICO calculates the score. When you apply for a loan, banks pull that report. It's basically a financial background check. Good news, it's not a mystery. Your score isn't fixed, it's a living, changeable number. Understand the rules, avoid common pitfalls, and you can build and protect your score. Next, we'll cover the mistakes that tank scores and simple fixes to avoid them. Because building credit isn't about being rich, it's about being responsible. So, we've established that your credit score is a big deal, but let's really hammer down on why it's practically everything for your finances. The most obvious reason is interest rates. Let's say you want to buy a car. With a fantastic credit score, 780, you could get a loan at 4%, walk in with a 620, and that same lender might charge 12% or more. On a $30,000 car over 5 years, that's a few thousand versus over 10,000 in interest. You're literally leaving money on the table because of a 3-digit number. It goes deeper than car loans and mortgages. Your credit score can affect where you live. Landlords and property managers run credit checks on applicants. They're checking for a history of paying bills on time. If you have a low score, collections, or past evictions, they may see you as risky. They could deny your application or demand a much larger security deposit, sometimes months' rent up front. Your credit can even impact job prospects. It's not every job, but more employers are checking credit, especially finance roles, management positions, and jobs that involve handling money. They often pull a version of your credit report during background checks. They're not always looking at the score itself, but at the details in your report. Late payments, high debt, those red flags look like irresponsibility. That can cost you jobs that require trust and accountability. Finally, the cost of everyday services. Think about your cell phone plan, setting up electricity or gas in a new apartment. These companies often run a credit check before starting service. With poor credit, they may demand a hefty deposit just to turn on the lights. Insurance works the same way. In many states, your credit affects auto insurance premiums and home insurance premiums. People with lower scores file more claims, so insurers charge higher rates. It's a hidden tax that costs you month after month. Alright, let's dive into the #1 absolute worst thing: making a late payment. This is the cardinal sin of credit. Payment history equals 35% of your FICO score. More than a third. Did you pay on time? When you miss a payment, a giant red alert goes off at the credit bureaus. They see it as a major sign of risk, immediate and severe. How it works is simple. Lenders report your activity to the credit bureaus every month. They report, paid on time 30 days late, 60 days late, 90 days late. A payment isn't considered late for reporting until it's a full 30 days past due. Example, if your bill is due September 10th and you pay September 25th, you'll likely get a late fee from your bank, but it probably won't show on your credit report. But once you cross that 30-day threshold, the damage is done. That late payment gets recorded and can stay on your credit report for 7 long years. One late payment can be devastating. Someone with a 780 score could see it drop by as much as 100 points. That's enough to move you from excellent to fair in one fell swoop. The higher your score, the more you have to lose. A 60-day late payment is more harmful than a 30-day one. A 90-day late payment is significantly worse than both. It's a landmine because it's so easy to step on by accident. Maybe the bill got lost in the mail. Maybe you forgot the due date. Maybe you were a little short on cash that month. The single most effective strategy, and I cannot stress this enough, is to set up automatic payments for all of your credit accounts. Every single credit card, loan, and bill you have almost certainly offers this feature. You can choose to have the minimum payment, a fixed amount, or the full statement balance automatically debited from your checking account on the due date. This is your ultimate safety net. It makes being late virtually impossible. So here's the pro-level strategy: set up auto pay for just the minimum payment. This ensures that you will never, ever be marked as late on your credit report. Then you can still go in manually before the due date each month and pay off the rest of the balance, or as much as you can. This gives you the best of both worlds. Another simple but powerful technique is to use calendar alerts. As soon as you get a new credit card or loan, go into your calendar and set up a recurring monthly reminder for about 3 to 5 days before the actual due date. By setting it a few days early, you give yourself a buffer to log in, review the statement for any weird charges, and make the payment without feeling rushed. And finally, if you do slip up and realize you're a few days late, take immediate action. Pay the bill right away, and then call your credit card company. If you have a long history of on-time payments with them, you can often just ask for a goodwill deletion. The third common mistake that can mess up your credit score is going on an application spree. This is when you apply for multiple lines of credit in a very short period of time. Every time you formally apply for new credit, the lender performs what's called a hard inquiry, or a hard pull on your credit report. This is basically them officially requesting to see your full credit history to decide whether to approve you. Each one of these hard inquiries can knock a few points off your score, typically somewhere between 2 and 5 points. But the problem is when you accumulate a lot of them quickly. A report with 10 hard inquiries in the last 6 months looks very different from a report with just one. To lenders, a flurry of recent applications is a major sign of desperation. The best way to avoid this mistake is to be strategic and space out your applications. Don't just apply for cards on a whim because you got a pre-approved offer in the mail. Do your research first, figure out which card or loan is the best fit for you, and apply for only that one. If you're denied, don't immediately apply for another one. Instead, take a look at your credit report, figure out why you might have been denied, and work on improving your score before you try again. A good rule of thumb is to wait at least 3 to 6 months between applications to allow your score to recover. So let's wrap this all up. Building an excellent credit score really isn't some complex mystery. It boils down to avoiding a few key mistakes and consistently practicing good financial habits. We've seen how devastating the 3 most common errors can be. First, the late payment, the absolute worst thing you can do. It makes up 35% of your score and stays on your report for 7 years. Second, high credit utilization. It makes you look financially stressed. It accounts for another 30% of your score. Third, applying for too much credit too quickly. It signals desperation. Too many hard inquiries will ding your score. The path to a better score is simply to do the opposite of these mistakes. It all starts with your payment history. The single most important action you can take starting today is to pay every bill on time, every month. The easiest way to guarantee this is to set up automatic minimum payments on all your accounts. That creates a foolproof safety net against late payments. It's the bedrock of a good score, non-negotiable. If you do nothing else, do this. It's the 80/20ths of credit building. 20% effort for 80% of the results. Next, tackle your credit utilization ratio. Keep balances as low as possible, ideally below 10% of your total credit limit. Pay down debt. Ask for credit limit increases on existing cards. One phone call can cut your utilization in half without paying down $1. Instant boost. Finally, be patient and strategic with new credit. Don't fall for every shiny offer. Treat credit applications as a limited resource. Do your research. Apply only for accounts that suit your needs. Building a great credit score is a marathon, not a sprint. Pay on time. Keep your balances low. Be thoughtful about new credit. You're building a financial reputation that will open doors for you. It will save you thousands, maybe hundreds of thousands, over your lifetime. That's an ROI too good to ignore.